Hey, I'm Jonathan Wild, and we cover how to record small stock dividends. A stock dividend is a distribution of additional shares of stock to the corporation's own shareholders. Like a cash dividend, stock dividends are declared by the corporation's board of directors. However, unlike cash dividends, stock dividends do not reduce assets or total equity. Stock dividends can be used to make the company's stock price more affordable and attract new investors, and is also used to show confidence in the corporation's future prospects. Now, accounting for stock dividends depends on whether the corporation declares a small stock dividend or a large stock dividend. A small stock dividend is when the corporation distributes 25% or less of previously outstanding shares. And a large stock dividend is when the corporation distributes more than 25% of previously outstanding shares. In this segment, we will focus in on small stock dividends and cover large stock dividends in another segment. Let's do an example to show how to account for small stock dividends. So, similar to cash dividends, we focus in on 3 dates: the date of declaration, the date of record, and the date of payment. And we start with the date of declaration. So assume a company declares a 20% stock dividend on December 31st. The company had 25,000 shares outstanding before the declaration. So the stock dividend is for 5,000 shares. The par value of each share is $1. Now, when recording the declaration of a small stock dividend, we capitalize retained earnings for the market value of additional shares being distributed. But what does that mean? Well, to capitalize retained earnings means we essentially transfer the value of the stock dividend from the retained earnings account to the common stock account. The market value of that transfer is computed as the 5,000 shares being distributed multiplied by the current stock price on December 31st of $10. This means the market value of these shares is $50,000. Now, to record the declaration of the dividend, we debit retained earnings for $50,000, credit common stock dividend distributable for $5,000, and credit paid in capital in excess of par value common stock for $45,000. We debit retained earnings to reduce that equity account for the market value of the distributed shares. We credit common stock dividend distributable, which is an equity account that is only in our accounting system until the shares are distributed. The $5,000 was computed as the 5,000 shares multiplied by the $1 par value. We credit the equity account paid in capital in excess of par value common stock for $45,000, as this was the $9 difference between the $10 market price and the $1 par value, multiplied by 5,000 shares. The interesting part is that after this declaration, total equity has not changed at all. We decreased one equity account for $50,000 and increased 2 others for a combined $50,000. The next big date is the date of record. In our example, that is January 12th. Anybody who owns the stock on the date of record will receive a dividend. We don't make a journal entry on the date of record because we are just determining who will receive a dividend. Now last, the date of payment is the date when the corporation makes the dividend distribution, which in our example is January 18th. To record the distribution, we debit common stock dividend distributable for $5,000 and credit common stock for $5,000. All this entry does is transfer the $5,000 balance out of the common stock dividend distributable equity account and transfer it to another equity account, common stock. We do this because the common stock has now been distributed. In the end, total equity has not changed from before the small stock dividend. All we did was transfer the market value of the small stock dividend, which was $50,000, from the retained earnings account to the common stock account and additional paid-in capital account.